analysis does. So liquidity map is our main focus of our technology, which is showing you based on market maker options where the quickest path to liquidity can be. It's our main technology here. But we also have other calculations that have very little to do with options. They have to do with a lot of other things. And so in trading strats, you'll see those calculations listed all right here. There are irrational and rational market checks. Irrational market has a set of rules I follow. For instance, when the market's irrational, I don't use liquidity map anymore. I need the market to be rational to make a lot of sense for me. So every morning I just make sure that the market's not irrational. And then I'm saying if it's rational, okay, check, let's go. If it's usual market, I'm ready to hit pretty heavy on whatever I'm doing, long or shorting. Irrational markets, it's buyers and sellers are everywhere and all over the place. So these are usual and unusual markets. It's kind of like a gray area of me taking a caution. Usually in here, I'll take smaller positions or just, not really play too hard on these unusual market checks. So the stop rules will show all the things that have me stop no matter what. They're all listed here numbered. The irrational word is the trigger that is very important. It's important to today's subject. So no matter what I'm trading, bold letters right here. If I flag the irrational market flag for any reason whatsoever, get out, stay out. I click the most important trade I ever can make in my life, which is this little X in the top right corner of your platform. This guy right here, click it as fast as you can, and what will happen is your platform will close down. So learn to click it, close it down, and walk away, and don't care for the rest of the day. So the first and foremost, the easiest thing to understand is when VIX itself, right? VIX is the volatility index. But you come to the bot and it gives you just a number. And I pre-prep my chart every morning, $2.80. And every Sunday I'll get that number refreshed. So I'm gonna double check on the VIX and I take a little green band. And the way I do it in Thinkorswim is I will go and I'll use like the Fibonacci tool, Fibonacci retracement. And you can just draw your retracement here. And what I do is I just go in there and I edit it and I modify it. Like I just basically turn off everything but 0 and 1. And I make the distance, that distance in the bot, and then I just come here and of a certain distance. As you see, I have a 0 and 100, just made them all green, and the distance is whatever it should be. So let's double check just so I can demonstrate how to do it. $2.80. We're going to go down to here and we're going to market. And again, I do this, once you learn this, it just becomes habit. Every morning it takes like 5 seconds to get everything set up. So on Sunday, I make sure my Sunday prep is always the same. This is what, 28.50, so 29, 30, that's $2.81. Maybe we're off like a penny. What is it, 280? Okay. So if I were to make this 28.50 and 280 would be 31.30, right? Okay, easy as that. Now I have this particular band. So what I do is I measure from the low of the Globex session. VIX is not outside of that distance. So this is just a ruler. How far has it traveled? Well, it hasn't moved that far. And let's measure off the high of the Globex session. Again, this is the high. The Globex session is from the overnight from 6 p.m. Eastern until the following 5 p.m. Eastern here. So from the high, it hasn't traveled. So it's the entire day is contained within that band. So check, VIX is not flagged at. It's good. So essentially it's a 1 second check. Every morning I come in there and I go, well, did we get there? No. And how do you know it's irrational? So let's show you kind of what happens. The market really loves to pivot heavy on these risk interval moves. Case in point, remember that big sell day we had last Monday? It's no coincidence that it fell exactly $2.80. And look what happened when it did the volume. Remember, our calculations predict volume. Bam, as you're tapping it, look at these volume spikes. The average trading volume of VIX, I think 200 and, is that thousands probably? And then it's trading at like, 4 times that as you're interacting with this. Just the volume starts to rapidly pick up. I mean, it's almost triples in that particular area. So the VIX has a hard time pushing its way outside of that band because the market is very hedged there. So as a trader, you can see when it does leave that band, it gets really, really, really nasty. So I'll show you some examples of when it has done that. And even before, like, look, here's that same distance here. You can see that when you get there, when you break through that band, look how violent that volume gets, right? Shows we know what we're talking about. What exactly happened at 14 o'clock that day? Nothing, right? Breaking outside that band is huge volume. 2,000 against what? 400. Literally 500% volume increase. Y'all see how big that is? That's to kind of show you how the market likes to stay rational. And then outside of that band, you get that massive capitulation and hedging on VIX. So just remember, I'm going to show you what the market does when you are outside of that range. Let's kind of click to an hourly chart and let's find it. Now, every Sunday, just double check that the market has, like here, let's look at a great example of this one. Looks like that day went to the edge as well. Let's find one where it actually broke. Recent memory. Okay, this is a great example of that. Does everybody see on this particular day? This is a Tuesday. You hit it and there was that massive resistance and then you broke through it. Look at how big those candles get. Volatility just spirals out of control. You don't want to trade up in here. That's the idiot's place to trade. You know, let the market be crazy and you just go have a beer or something, right? So that goes all the way back to, let's put a daily chart and I'll match it up to what happened on the SPY. Pretty neat little lesson here though. That is going to be on the 13th of September. So let's go back to that day. I don't remember what happened that day, but let's go find out, right? Go all the way back. There's a Tuesday. So as you see, let's go back to the other one. You're going to have, remember we had VIX hit that risk interval band and halted for a couple hours and the S&P halted for a little bit. And you think, okay, this market has dipped, but when VIX pressed outside the risk interval band, 40.17 all the way to 39.37, right? Let's talk about what is that? An 80-point drop? Another 80 points, right? Just because VIX became irrational. The market just had no bottom at that point. That's the danger part. So the reason we don't trade irrational markets, number one, is because you might think it's stalling out. You might buy the dip and off of what, 40.17 all the way down into, I have my glasses on, 40. Yeah, like almost 80 more points. I mean, you could blow up your account on that particular setup. So again, these rules are here for safety. So boom to boom. So matching up when you're outside of one risk interval, kind of just sit out of the market, let it do its thing, and just don't try to be overly eager. That little tiny bit of extra VIX, just that much, was 80 points in the S&P, which is highly, highly unusual, right? And so that's why we don't play. This volume spike that came out of nowhere 30 minutes before market closes is because of that. And the S&P just collapsed on its. Number two, let's go back to the Discord and let's go back to the stop rules. Number two, if the S&P opens outside of one risk interval of its own of the previous day's Globex close, we call that the Doomsday Bands. That is this little green line band. It's really much the same thing as the risk interval we just showed on the VIX. It's just for the S&P, but there's a different application. It's the VIX travels that much, it causes the irrational market. The S&P, the irrational market is if the S&P has traveled that much from the close of the previous day. It's a different mechanic, but from the close of the previous day, we take that same distance. And again, I'm just using, I wrote a little thing to just draw them. I type it in manually and then draws them. The S&P distance is pretty simple, 2750. So off of the close, there's a 2750 this way and 2750 that way. Anytime you were outside of the band, again, unusual volume in markets irrational. So there's one flag this morning. We opened right here outside of this band, right? The band is from here to here. We open out here, irrational market. And again, when you interact with it, there's always volume. So as you see, when you are playing with it, the volume starts to increase as you are tapping it. And then as you're breaking through it, right, that volume starts to decline as we talk about, and the volume has declined, and now you've stabilized outside of the band. Now our market opened outside of the band, already opens irrational. So what we say is when market opens irrational, get out, stay out, sit out, chill. I'm not making any heavy moves right now or trying to do anything else. I've entered nothing new on the S&P today. If UVXY is greater than a call wall, that's very simple. You go to Rocket Scooter and you just check what the VIX is doing. We use UVXY, there's a whole process for that, but just type it in. You're going to see if, as long as UVXY is in a call territory, which it is in the bull zone, not a good sign. So with the VIX being in the bull zone, again, that's also an irrational flag. So two in a row, right? Two things are saying sit out. Fourth one, a catalyst will exit both a winning and losing trade if one risk interval from the anchor point is achieved. So what do those words mean? Okay, let's go back to the S&P. A catalyst was here. We had non-farms this morning. The unemployment numbers came out. If a catalyst moves you more than one risk interval, then beyond that distance, the market's also irrational. This has to do with the market catalyst being strong enough to change the direction of the market. How do you know that catalyst is strong enough? Well, it broke through the risk interval from the impact point. So it's not the high or low of the day. It's the moment the catalyst comes out from that point in time, measure that distance. It goes to here. Like the minute you hit that risk interval, there's the highest volume. Again, all of our calculations predict volume. No volume is meaningless, and I hope you guys are learning that here. And then you come back and you test that level again with less of a volume spike, but again, you test it and there's the rejection. So the catalyst is now in the effect of causing the market to trade lower. So we have 3 of our flags flagging today. So today there's a lot of signs that just say the market's gonna be really hard to trade. So irrational or cat here. Anything down here, this is irrational DD. Doomsday has to do with the idea that the S&P is tracking other futures around the world overnight. And so if they're trading down, we're going to trade down, but we're not going to trade down outside of the interval band unless there is a real reason for our market to trade down. So do y'all see how this is very much like, you know, which is the first of the 4 happens? And immediately out the door, those first 3 signs that said, okay, market's irrational, don't want to trade anything or do much. Then I look right here. Because those are irrational, the S&P just fell through the floor like it was nothing, like it was butter. And normally you'll see hedge pressure having resistance, right? So when any of those irrational flags take place, one of the things we do is we completely throw out liquidity maps and all indicators together.